So if I can't buy the shares on the website, where do I buy them? To buy shares, you need to use the special brokerage company. There are a lot of different companies that you can use for that. Most online banks will have the brokerage as well, and then you can also use like online companies such as Freetrade or Vanguard. Obviously, in your countries they might be different. In the UK, mostly people use either Vanguard or Freetrade. There was also 212 Trading, but they were not taking customers recently. I'm not sure if it's still the same, to be honest. When I started investing, I literally googled like what is the first brokerage company that I can use. I found Freetrade, I registered, and it was fine. So in the UK, you can have a ISA, which stands for the individual savings account, and basically it is an account where you invest money, and any gains that you get in that account are tax-free, which is great, especially if you're saving money for retirement or if you invest in a lot of money. Then you don't pay tax, and we all know that taxes are a pain. However, they might be a little bit complicated to open comparing to like an online brokerage such as Freetrade. So when I started, I really wanted to test invest and see how it works and in general. So I just wanted to do it here and now, and the online brokerage firm was like the easiest thing that I could open. So I opened the Freetrade account within, I don't know, 10-15 minutes, and I was already able to buy some shares, some ETFs, just to see how it actually works. You can start with the online brokerage company because, I mean, again, this is for the UK. So in the UK, you only pay tax if your capital gains are more than 12,500, or if you receive dividends more than 2,000 per year. So this is not something that you will get straight away in your first year of investing. So to test it out, I mean, unless you're a millionaire, so that you can test how it works. And also within Freetrade, you can also open ISA. That one you have to pay, I think, £3 a month, or you open a general investment account, which is not tax-free, but it's completely free to use, and you can invest and sell shares very easily, obviously during the opening hours of the exchanges. So how to decide which companies to buy, which shares of which company to buy? It is a lot safer to buy a fund rather than an individual company, because fund covers a lot of companies in the same either sector or industry or country. So basically you're diversified and you don't put all your money in one company, which might fail. I'm pretty sure you heard the phrase, don't put all your eggs in one basket. This is basically what we are doing. So I'm pretty sure that all of you have heard about the S&P 500. So this is the index of 500 largest companies in the United States. Basically Microsoft, Tesla, Apple, everything is there, and it's 500 companies. So if one company goes down, the others are still kind of stable. So the total index won't be as volatile as one company. And just to give you some numbers, as this year was like kind of bearish, so all the markets right now are in a downward trend. But for example, if you check the individual investments since the beginning of this year, Tesla is down 45%, Netflix is down 70%, and this is not some like random companies, like one of the biggest companies in the world, and everyone was saying that they are like a really good investment. However, they are so much down. Comparing 45 and 70%, S&P 500 is down only 17%. Obviously, it's still a pain. However, 17% versus 70% down, it's a lot, and your money won't take that much of a loss if you invest in the index. So investing in index funds limit your downsides. Portfolio value won't go down as much as if it would if you invest in individual companies. Just a little bit more information about index fund. This is like a pool of money. So the main ones in the USA is obviously S&P 500, which covers 500 largest companies in the States. And then in the UK, there's FTSE 100, which is 100 largest companies in the UK. And it's a kind of indicator of how the economy is doing, what's happening in the stock market in general. And it's always a good place to start researching and start investing if you decide to do so. And index funds are also good because they're really easy to invest in. You literally just like buy a share every month whenever your dates are for investing, and that's it. You don't need to research companies. You don't need to worry about diversifying. There's already amazing diversification in the fund. Also, there's no one managing it. It's a passive investing, so the fees are usually really low comparing to some, I don't know, mutual funds or active investment funds. And they're also being rebalanced from time to time so that they reflect the current state of the economy. And you can say, but investing is risky. Yes, I know, my parents were telling me the same. My dad was literally saying every time that you lose more money in the stock market rather than in casino. Well, luckily right now we have more access to the information than they did in their youth and whenever they were supposed to learn it. And also, no one is saying that something is risk-free. Like, I doubt there's anything risk-free in general in life, and always investments have risks. However, if you choose the assets that you invest in very carefully and you diversify, then your risks are very limited. So yeah, in the long term, the stock market goes up. Again, this is based on the historical performance, and we cannot predict the future based on the historical performance, but we can see the trend. And I mentioned in my previous video as well, if the whole S&P 500 crashes down and goes completely to zero, it means that the 500 largest companies in the USA go bankrupt, and then I'm pretty sure there will be apocalypse in the world. I can't imagine this, that the whole market will be just completely crashed and erased. Then there will be no money, there will be no power. I don't know what's gonna be happening, and I guess the chances of it are like 0.00001%. So as long as you diversify and you invest long term, on the short term, markets can go up and down. We all know this. We can see it right now. The markets are really down this year. However, over the long period of time, ideally you should invest for at least 10 years, but 5 is the minimum, I would say. The market should always cover the losses that it had in a short period of bear markets and always go up. And people are saying, but no, index funds are very like passive investments and they only gives you around 10% a year. So if you invest yourself using the research and the news and you spend time on it, you sure be able to beat the market. Well, actually it's not true. Recently there was an article on the news that 80% of the fund managers get the returns less than the market, so less than 10%. And active fund managers are not people like just you and me who can research on their own. They have huge companies with a lot of analysts researching the stocks, having a lot of data supporting all their findings, checking the news. They have like a team of people looking for the good investments, and still they can't beat the market. So then why would we even try? The chances are we will anyway lose. So index funds are the key. It's very easy. You invest once a month and you forget. If you invest in a good index fund over the long term, it will always grow, so you don't have to worry about this short-term volatility. And if you're saving for retirement, or even if you're saving for something in 10 years, this is an amazing instrument to use. This was the part 2 of the series of how to invest as a beginner. I will do another one shortly, like in a week or so, what is important to check before you invest, and some important strategies when investing. Please let me know in the comments if there's anything in particular you would want me to cover in the next video, and I will absolutely do so. Thank you for watching. Bye bye.